Hello, everyone, and thank you for taking the time to join Cobalt Blue and our investor webinar. Today, you've got me as your host. I'm Joel Crane, the Investor Relations Manager, and I'm joined by CEO Joe Katarevic, Executive Manager Andrew Tong, and a special guest, Dr. Helen Digeling. So the way this will work, or the intention of today's webinar, is to provide an update on the progress of the Broken Hill Cobalt Project DFS and other business-related achievements, but really want to focus on the newer strategy around the Kwinana Cobalt Refinery. So just in terms of the format, this will be about 45 minutes in total. We'll start by taking a moment to introduce Helen, and then Andrew will give us an update on the DFS and the progress around the demonstration plant. Joe will talk about the Kwinana Cobalt Sulfate Refinery, and then I'll wrap up with some views on the current state of the cobalt market, and then we'll open it up to Q&A. So with that, I think I'll just pass it over to Helen, who's recently joined as our Project Acquisition Manager. Helen, if you could just give us a few moments of a little bit of your background and what your role will be with Cobalt Blue.
Thanks so much, Joel, and hello, everybody. I've been with Cobalt Blue for about a month now as Project Acquisition Manager, and one of the main focuses of my role will be to take up carriage of the Cobalt in Waste Streams project. Now, as an introduction, I have a background that spans about 15 years in base and precious metals exploration, as well as stints in academia and most recently in government. So while I was working as the Director of Minerals in the Queensland Government, I instigated a large program with researchers at the University of Queensland to examine the potential for critical minerals such as cobalt in mine waste, like tailings and other waste stockpiles. That program has now grown to become a nationwide initiative, which reflects the strong potential for revalorising and reprocessing waste streams. Cobalt Blue has been a partner to the Queensland Government Research Program for a number of years now, and what we bring is a strong basis in processing expertise to demonstrate that extraction of cobalt from the mine waste of copper mines, for example, is feasible. And it is through this work and collaboration that I have come to be part of the Cobalt Blue team and take on the Waste Streams project. Now, I'm starting that work by trying to understand the information that's already available and producing a short list of projects that match Cobalt Blue's ambitions for ethical cobalt supply and our world-leading expertise in metallurgy and minerals processing. Our aim for this project is also to feed directly back into the three-pillared strategy that you'll hear more about from Joe shortly by working in parallel with the Broken Hill project to then produce feedstock for the Kwinana Cobalt and Nickel Refinery. To demonstrate the potential scale of opportunity for the Waste Streams project, one of the examples that I often come back to is the very large tailings dam at the Mount Isa copper mine in Queensland, which is currently held by Glencore. That tailings dam covers an area of around 22 square kilometres. The depth of the tailings dam is variable and poorly defined, so we don't have an accurate estimate of the volume of that material. But regardless, we know that it's large. We also know that there are spot grades of up to 9% cobalt associated with copper mineralisation at Mount Isa. And we know that Mount Isa mines produced cobalt along with copper, lead and zinc for a couple of years in the 1990s. Copper production halted when the cobalt price dropped. Before and after that, cobalt, which is largely hosted in pyrite at Mount Isa, was sent to waste. So we know there's cobalt there, and the Mount Isa mine is hardly the largest of this sort in Australia or the world. So, like I said, the opportunity is very significant. Another advantage of the Cobalt Blue process that is starting to attract attention is the fact that elemental sulfur is one of our byproducts. So in essence, this means that we are leaving the material that we work with lower in sulfur than when we found it. And this has great benefits when looking at mine waste. As we all know, acid mine drainage is a big problem for metalliferous tailings globally. So not only do we have the potential to extract value from these sites by looking at metals that the original miners have ignored, but we can also produce strongly positive environmental outcomes for those sites by desulfidizing the remaining material. This produces yet another saleable product and reduces the environmental liability. And it is very attractive to the operators of large, long-lived mines around the world who might be left with huge environmental maintenance costs even after the mine has closed. Now, I am passionate about the circular economy in mining and positive outcomes for mine sites, as well as working with such an ethically credentialed company like Cobalt Blue, providing battery-ready material for the clean energy transition. So being able to take a project that I started in government, grew to a nationwide initiative, and now have the opportunity to continue working on from a commercial perspective is so pleasing to me, and I feel so lucky to have this opportunity. It's something that I care very strongly about on a personal level, and you can absolutely be assured that I will be giving it my all. Thanks, Joel.
Thank you, Helen. It's just it's very clear to hear your passion for not only this part of the sector, but just your work from the past. It's great to have you. And we do often get a lot of questions around the Cobalt and Waste Streams projects on these webinars, so please stay tuned. We'll come back to you. With that, let's move over to Andrew, who's going to give us a quick update on DFS and what's happening on the ground with the demonstration project.
Thanks, Joel. So a quick update on where those activities are going. Let me start firstly with the DFS, because the demonstration plan's a subset of the DFS. Just for a quick recap, our DFS is being run by Cobalt Blue, and we've engaged 3 key engineering firms to help us on this: Worley on the process plant, GHD on the non-process plant infrastructure and the services and the EIS, and SRK on the geology and mining. So we've got these 3 major engineering groups helping us on our DFS. There's a lot of different work activity streams progressing along that. At this stage, we're guiding that the DFS will be completed later this year in Q4, and there's a lot of activity that needs to come together for that. Essentially, the DFS is an economic evaluation of the project, so the DFS will publish CapEx and OpEx numbers. It'll be based on technically credible information, so that covers everything from the aspects of the drilling for the geology and the resource, through to the mining, through to the processing, which is largely based off the demonstration plant and pilot plant results with some ancillary test work. And then a lot of the information that's being gathered from GHD around the waste management strategies and the EIS. So all of that will come together ultimately in a capital and operating cost estimate for the project. It's at that point then we're able to release that information to the market and move towards a project finance. So those things are ahead of us, but right now we're very, very busy in the depths of the DFS. I'm happy to answer specific questions around that as we go forward in this webinar. In terms of the demonstration plant, that continues to operate. Again, a little bit of context. Last year, we spent quite a bit of effort mining out roughly 5,000 tonne of ore out of the ground. We then processed that into concentrate at the mine site. So that block of work was completed last year, and then we've been working through the characterization and the write-up of that work. That's then progressed over to the different engineering groups, SRK on the mining, where it's relevant, and to Worley on the concentrator plant, where it's relevant. This year, the focus in terms of the demonstration plant has been processing that concentrate into MHP firstly, and then MHP refining into cobalt and a small amount of nickel sulfate. So those activities have been going on for a number of months now. We continue to do that every day. Right now, we're running a leach campaign as we speak at the moment. Last week, we were running a kiln campaign, so processing the concentrate through the kiln, turn it into pyrrhotite, and then leach the pyrrhotite, recover the cobalt. So each week, every 2-week block, we do various trials and activities. A lot of that work is looped back in an iterative circuit with Worley as they're progressing in their designs. So for example, one of the issues that we've been working through with Worley has been the effect of particle size of the material as it goes through the plant. So coarse particles, fine particles, solid suspension with agitation, the pumpability of those particles. And we've been doing full range particle size or cuts at various sizes and looking at the performance of those. So that's an example where we've taken a particular technical aspect and pushed that through all of the circuits to make product, MHP and cobalt sulfate, but we're trying to evaluate the effect of particle size because that has such an impact later on in the engineering design, size of your pipes, the power that needs to go into the agitation, those sorts of aspects. So we work very closely with Wally on the test work programs that the demonstration plan are executing and on the results that come out of that program that then go into the Wally design. So we anticipate running that plant for at least 3 or 4 more months. And then after that, we'll have to see what further work there is required, depending on where the designs get to in the DFS. But hopefully that provided us a bit of an update on the demonstration plant, and happy to add some more questions as we go ahead in this webinar.
It's a great start, and I'm sure there will be lots of questions. Joe, can you go ahead and start giving us an update of what's happening in Kwinana?
Yeah, thank you, Joel. I'll tend to focus on the business and commercial side in this presentation. So Joel, I'll just get you to go to the next page. This one's a quick reiteration. There are 3 building blocks or 3 assets under Cobalt Blue: the sulfate refinery or the Kwinana Cobalt Refinery, the Broken Hill project, which still remains centerpiece, and the Cobalt and Waste Streams initiative that Helen eloquently introduced. I would add, none of those 3 have priority. They're all independent. And we are progressing on the Broken Hill Cobalt project as we speak. So we get some commentary over priorities as we go forward, but they're all independent and they're all our priority. In terms of the sulfate refinery or the Kwinana refinery, there are 3 stages to its growth. Stage 1 will be a stage where we basically process third-party feedstock. Why is that? Because on our target, we want to be in construction of this refinery by the second half of next year, and we want to be in production with respect to that initial stage by mid-25 or second half 25. That will necessarily run in advance of Broken Hill Cobalt, which has a longer period of financing and a longer construction period, given that it's physically, in capital terms, circa 10 times the size. So stage 2 will then feed into Broken Hill. So Broken Hill MHP will be railed into Kwinana, and that will form stage 2. So it'll go from a 3,000 tonne metal equivalent refinery to somewhere in the order of 7,500 tonnes with stage 2. And then I'm looking at Helen as I speak now. Depending on the success of Waste Streams, we then have the ability to ramp that even further with further critical minerals through Waste Streams through this project that Helen is running. So overall, we are committing ourselves to stage 1 and 2 at this stage. Stage 3 at this stage is left open for potential future success. Thank you, John. In terms of where that would put us, and I'm just putting a mere 4,000 tonne of cobalt comparison. I've already said to you, stage 1 is 3 and stage 2 is another 4.5. So we've just put roughly a 4,000 tonne equivalent refinery on this chart. That's a top 10 or so refinery globally. It'll be one of the few non-Chinese controlled cobalt sulfate refining entities in the world. And that makes it highly sought after with respect to evolving legislation, both in the EU and the US. So you've heard of the Inflation Reduction Act, and you can only qualify for the clean vehicle credits as part of that act if you extract or process in an FTA country. So if we can source third-party product from FTA or aligned countries, we can process it in Australia. We then qualify for those vehicle credits. And it's our strong view, as it is the view of our potential partner, which we recently announced. It's both our views that going forward, that those products will feed into these allied nation production chains, typically EU and US, and will be subject to premiums relative to today's market. Because in amongst themselves, those consumers in those markets want a product that's sustainable, ethical, low CO2 footprint. As a result, it then narrows the supply from which that cobalt can come from, and we're certainly happy to put our hands up for that. Thanks, Joel. This last slide is just a very quick one. It's almost a lesson in geography to show where the mine at Broken Hill will be, how it'll feed into the Kwinana refinery, the other potential sources of intermediate cobalt and nickel be it waste streams, be it domestic other production. So a key part of the go-to market for the refinery is our ability to take intermediate cobalt nickel feedstock from Australian producers, Australian miners typically, and provide a gateway to the global battery industry via the Kwinana refinery. This is an area where First Mover has every advantage, and it's an area that we can effectively get a margin on other people's products as they pass into supply chains globally. The last slide there, or the right-hand side of that slide, shows the potential collaboration. Kwinana is the only district in the world where all the elements of the battery pass through in some process state. So that's lithium, nickel, cobalt, manganese. It is the only district in the world, and it makes a lot of sense for there to be future collaboration in downstream processing to make potentially cathode precursor in Australia. Thank you, Joel.
Thanks, Joe. I'll just wrap up here with just a comment on cobalt pricing, and we'll open up to Q&A for anyone who has questions on any of these topics. Look, it will be no surprise to most people on this call to hear that cobalt prices remain relatively weak. There's two factors driving weaker cobalt prices. Larger than normal supply growth is the first one, and that's primarily from Congo. Look, the cobalt supply growth in Central Africa is really a function of the copper bull market. Copper's been the flavor of the past decade, or arguably the past 2 decades. There's been a lot of investments into producing both brownfield and greenfield copper projects. And so this massive investment in a number of these projects has come at a time, quite simultaneously. A number of projects all at once have come, and with large scale volumes of cobalt coming along with that, obviously, given that it's a byproduct. On top of that, the second reason for weaker cobalt pricing is relatively weak demand from consumer electronics. Right now, that sector represents just around 1/3 of total cobalt demand, and mobile phone and tablet sales growth have been negative for the past 3 quarters. So that's really dampened demand growth, even though the EV sector remains very, very strong for cobalt. Just that one particularly large sector, which is consumer electronics, has remained weak. So the question we often get is, when will prices rebound? Well, of course, it's quite difficult to forecast, but we do feel confident that it looks like prices have started to find a bottom. Of the 2 bear factors that I just outlined on supply and demand fundamentals, supply growth will remain strong the rest of the year. But there are signs that consumer electronics is regaining growth. And in fact, sulfate prices just over the past couple of weeks have ticked up just on the back of that, because Chinese producers of sulfate are restocking as they're getting signals from the sales sector is picking up. So I don't think that this one particular fundamental is going to cause an immediate rebound in the cobalt price, but it certainly helps stabilize it. I think we will now open it up to Q&A. Just looking through the questions, there's a lot, Joe, on some of the refineries, so I'll sort of start with a few of those. And of course, Andrew, jump in on any sort of technical side. So a lot of questions around, is this refinery discussion a change in strategy? And does it delay the timing of the mine and the DFS?
I can take that in the first instance. I'll take the latter first. No, it doesn't change any of the timing for Broken Hill Cobalt Project, BHCP. The feasibility study that will drive ultimately outcomes for the refinery will be part of that BHCP feasibility study. It was always intended to be, except the pivot now is that it'll be locationally distinct in Kwinana. The best way to describe BHCP is it's an integrated flow sheet, now spread across 2 separate geographical locations. So it doesn't take away at all from that. In terms of timing, the FS will be due in Q4, as we discussed. That'll be published. And in terms of the refinery timing from that point, we expect to then progress our relationship with our Japanese partner from a non-binding agreement we have today into a binding arrangement in Q1. We don't expect financing to take a lengthy period, given that the capital numbers are fairly modest. So we've already guided the market, Joel, to a 70 million Aussie dollar pre-production capex. And just to give some insight into what will happen around those numbers and ownership, our partner, or I need to keep stressing our potential partner, as our lawyers would have me say, our potential partner is a Japanese trading house. And so they're not just our landlord, given that they've got prime real estate in Kwinana, they're potentially a joint venturer or an equity partner with us. Now that's in the public domain. So of that 70 million, there'll be a portion that the partner will put their hand up for because they are naturally a cobalt trading house. And then beyond that, we're looking to source other sources, including some government assistance. Government assistance isn't just money, it's also permitting and approvals. And then we go into debt and or equity. But we want to keep it a fairly clean structure, and we want to move to the back end of Q1, Q2 next year with an outcome of investment decision equivalent. So we want to be on that timeline I mentioned before of say a July Q3 next year, first construction.
Can I just add to that, Joel? I think it's important to realise where we are responding to the market, and the refinery, by wanting to bring that online earlier than Broken Hill, needs to be viewed through the lens of where's the gaps and what's the market telling us out there. And with the big changes to US legislation, even the things going on in the EU at the moment, there's a significant refocusing of mines throughout the battery supply chain and the OEMs around compliant raw materials. And the biggest question we get asked by the market is all about refining capacity and how soon we can get that on. And that's why we're really trying to push hard on getting this refinery up, because there's so much interest in feeding or streaming material through that to, as quickly as possible, develop raw material supply chains that meet with that legislation. In no way does that detract from our mine. It's just that that's where the market really wants to push as soon as possible, with a longer term or mid-term view being the mine will come online and that'll be fantastic at the right point. It's just that there's a lot of questions about getting a refinery up.
Yeah, I just attended a Benchmark Minerals conference around gigafactories and all this, but the buzzword for the two-day conference was definitely midstream refining capacity. That is where everyone is identifying gaps and where everyone is trying to fill. So our strategy here is slotting in quite nicely. Andrew, keeping with you, what about the approvals for the Kwinana Cobalt Refinery? Have you already started on the sort of documentation around that? How is that being prepared?
So we're working with our, as Joe mentioned, our landlord or potential landlord down there. The first thing we did this year is to really work through the optionality for the best site location. We've now got our preferred location. That's already an industrial site with all their own permits in place. However, they're not refining cobalt and nickel. So we haven't yet commenced a documentation process. So we haven't yet commenced preparing those documents. What we're working through right now in this month of June is working out exactly what is required to update the existing site permits. So is it a variation? Is it a modification? Is it a new permitting structure? Those are the sorts of questions that we're now discussing with West Australian Government. And once that's clear, then we'll be able to say, look, it slots into this path or that path, and then start preparing that documentation appropriately.
Right. And another one on the refinery. Will it be able to process different cobalt and nickel composition from different mines? How flexible will it be versus mining our own product?
Yes, I sort of touched on that a little bit earlier in my comments around the market gap. The key space that we get asked is really from other suppliers, not necessarily the mines, so some of them, it's really those sort of trading groups that are taking material from other mine sites and are currently processing that through what I'll colloquially use as a China supply chain. And they're looking for alternative refineries to do that. Their options for that are very, very limited at the moment, and hence there's a number of parties around the world looking to build these refineries. So within that context, we're designing this refinery to be able to accommodate a set amount of cobalt and nickel. But the difference between mine sites is all about the trace metals. So how much copper do they have, or zinc or manganese? So by setting this refinery up now, we're able to design it and say, look, we can accommodate this much trace metal. So then when we go do the supply arrangements, we can take a bit from mine A or a bit from mine B, ensuring that we don't exceed our trace metal removal, because that's really the normal main constraint on feedstock is the trace removals. And so that's how we're approaching that. We're then obviously looking to expand that refinery to accommodate BHCP material. And this gives us a distinct advantage over pretty much all the other people trying to play in the refinery space, is that ultimately will be underpinned by vertical integration from our mine pit all the way through to cobalt sulfate. And by doing that, we get the economy of scale, the vertical integration to underpin the refinery economics. Being a simple refinery, inverted commas simple, relying upon supply and offtake contracts, the margins can move up and down quite a lot. Having your own supply, of which we'd be estimating, the dominant source of material into that refinery longer term is going to come from Broken Hill. That might be 50, 60% of the feedstock into there. That underpins the economics of that project.
Thanks. Sorry, just one more for you, Andrew, while we got you. A number of questions just around project CapEx. It does seem quite low compared to other projects. Are you vastly underestimating inflation or other costs?
Joel, this is in relation to the Broken Hill project?
To me, it sounds like both. I think the 70 million from the refinery sounds quite low, and maybe I think that's probably what they're referring to.
Okay, so in terms of the refinery, we need to sort of highlight that we're going into an existing site. It's not building up from the ground level. So the site that we've identified already has, and no particular order, things like security, offices, laboratory, weighbridges, buildings, power transmission lines, water connections, all those sort of services are there. And there's a block of flat land that's already had the civils, large surface earthworks already done. So to be able to go into a site like that is shaving off millions of dollars compared to identifying a vacant block of land and having to go through all of those aspects. It also means that on the permitting side, we're well ahead of the starting point, again, if you had a vacant block of land. So those are some of the reasons why it took us a while to find the best site, because we wanted to do that with partly a view to minimising time to market, hence the permitting side, and also reducing the capital outlay to build it. On a more technical aspect, one of the things that you've got to keep in mind is that we're only looking at inverted commas, a small refinery. So typically in the cobalt space, the feedstocks that we'll be purchasing or bringing in are roughly 40% cobalt, give or take a little bit. So to produce initially 4,000 tonne of cobalt, we only need to bring into site 10,000 tonne of material. So to give it some scale, that's just a few tonne a day of throughput that you need to be able to produce. Where this gets a little bit different, and I guess this is the market dimension, is that most mining companies are used to dealing in millions of tonnes of rock movement and therefore large equipment. Moving into the refinery is really chemical processing. And so it's much, much smaller equipment and smaller material movements. So the relative nature of the capital costs, the pump sizing, the agitators it takes are much smaller. And for us, and I guess with our experience going through the demonstration plant, it's a next step up from the demonstration plant scale. It's not going all the way to the full commercial mine site. So for us, we're reasonably comfortable with the capital costs that we've got at the moment.
Right. I think that's very clear. Moving topic, or maybe evolving topic a little bit. Joe, this is a pretty popular topic about premiums potentially paid for ethical / IRA compliance material. What's your view on how the market's going to play out?
Well, I'll give you two answers to that. First is an anecdote from today's market, and as we've mentioned in previous ASX announcement, Joel, Andrew, and myself were attendees at the Cobalt Congress 2023. So that's an annual a market get together from everyone from the upstream producers to refiners, processors, traders of those products, and all the way downstream to some of the biggest vehicle OEMs on the planet. There is already clearly premiums attached to compliant supply for IRA and EU, particularly for the IRA. In other words, if you make the following criterion, then there is a premium to be attached. That's done on an ad hoc basis as those contracts fall due. Going forward, the firepower that the US have put into the market through the IRA, this clean vehicle credit, and I would encourage investors to do some research on the clean vehicle credit. There's $37.50 US of net tax benefit per vehicle. And if you assume that's a 60, 70 kilowatt hour battery, you assume some fairly punchy, 811 cathode, so fairly high-tech cathode, you back out of that very quickly that the US is paying for the entirety of all the critical minerals in that battery. So I'll say that again. The US is paying for the entirety of all the critical minerals in that battery by virtue of that tax rebate. So what that's telling you going forward, in order to be a compliant supplier, there's enough value effectively to pay for all of those minerals, I should say, at long-term pricing, to go into that chain. So I think there's not only an emerging premium price, but I think there'll be a well and truly baked in premium price index for those markets going forward.
Thanks. And while we're on the geopolitical topic, I know this would be a difficult one to answer, Joe, but what does the new agreement with the US mean for Australia and the company?
Yeah, look, I'm going to play a fairly straight bat. We are due for some discussions in Canberra, and that should give us a better indication of what happened in, you're referring to this Hiroshima Pact, that was the subject, was an outcome of discussions between the US President and the Australian Prime Minister. I am broadly aware that the Australians put their hand up and asked for some further support in bringing the upstream into play that would ultimately support the US economy. In other words, it's one thing to incentivize EV sales in the US. It's a completely separate series of policies to incentivize the upstream mines and processing units. And one simple difference is just the time it takes to bring a mine into production is simply so far longer, so much longer than the time it takes to reinvent an EV for effectively sales. So I am broadly aware that it brings some of the North American tax benefits into the Australian context. So i.e. treats Australia as I will call the 52nd state of the US, with Canada being already given the privilege of being the 51st state. So some of the advanced manufacturing credits, some of the capital credits, I believe are on the table. I've also been warned, warned's the right word, to not be too optimistic until it passes through the US Parliament or the US Congress in this case. So it still has some heavy lifting to do, but it would be an enormous outcome for Australia if some of that was realised.
Yeah, that's right. At the conference I just attended, that was a pretty heavily discussed topic, and it's basically just trying to, there are already a number of Australian companies that are receiving US funding, but those are companies with projects within the United States itself. So this really is just extending that to US being able to help fund projects outside of the US, is what it appears to be. But we're still waiting for more detail.
Yeah, I think, Joel, it's important to remember the time critical nature of this. So the US is trying to push so hard to incentivize these new supply chains, and they want that to happen from largely 25, 26 onwards. So the window to get to that start line is closing very quickly. And as discussions progress here, the IRA was only announced late last year. Within the first 6 months of this year, there's been a huge flurry of activity and investment. But there's also a growing realization of what is practical and where it's practical. And I think part of what this potential agreement between the two countries is all about is where can things happen in that time frame. And I think Cobalt Blue is well placed to play into that, but we're still waiting to see the details.
That's right. Thanks. Moving topic again, I promised Helen we'd turn to you. Got an interesting question here. What strengths does Cobalt Blue bring to potential cobalt and waste streams partners?
Oh, well, our strengths, I think, are really across a number of streams. I can't highlight strongly enough the value of Cobalt Blue's metallurgical expertise and IP. That really is a standout compared with other equivalent companies, I think. And the evidence of this is the number of patents that we have associated with our process for the Broken Hill project. So Andrew, of course, can speak with far more authority about that, but I see that as a real strength. We also have outstanding business and financial nous to take to, in the waste streams project, to take to what are essentially unloved and seen as difficult projects. And I think that having that combination of technical and business expertise really will help to make that a reality. And then for myself, really apart from a couple of researchers at the University of Queensland and RMIT in Melbourne, I think I understand better than just about anybody the scale and diversity of opportunity in mine waste. So I know I have the contacts and the reputation to be able to open those doors for us. And I also have the understanding and the expertise in government to be able to navigate the regulatory frameworks of what's essentially a new frontier of mining operation with respect to mine waste projects. So really, I think we have the right team and we're in the right place at the right time. And we have the ability to get the right people in the room to make waste streams a commercial reality.
Yeah, I think this will increasingly become a topic discussed a lot because there's A, so much material available, and B, it's getting rid of some of that waste.
Yeah.
I've got a question on the cobalt market itself, so I might just take that one. Has current demand for cobalt diminished? Why or why not? Just sort of retouching on what I did discuss, I don't think demand is diminishing at all. In fact, it remains extraordinarily strong. We don't talk about the EV market as much because I think everyone's in agreement it's an extraordinarily positive outlook. And there are a number of different forecasts out there, but all of them are relatively bullish, and that's fantastic for cobalt. But of course, we get a lot of questions around battery chemistry and whether or not we're concerned that switch over to non-nickel and cobalt bearing chemistries is negative. And perhaps that's why cobalt prices has been hurt. I think it's very clear that is not a reason why cobalt prices have fallen. We speak to almost all the major battery and automakers, and the number of gigafactories that they have all committed to that are producing nickel and cobalt bearing cathodes is extraordinarily high. Yeah, there have been some announcements of LFP and other non-cobalt batteries, but the fact that these gigafactories are being built out over the next decade or two just tells us that cobalt demand will continue to remain strong. And just on the consumer electronics, these past 3 quarters that have been negative demand growth, that is extraordinarily rare for our consumer sector. It's just sometimes it can be quite weak, but we haven't seen negative consumer numbers since the GFC. So a lot of that has to do with concerns about global recession, and of course hangover from COVID, that people aren't buying as many things as we did during COVID. But certainly it does look like consumer electronic demand is going to rebound, and that's going to help the cobalt price. Moving along, Joe, a number of questions around our balance sheets and whether or not we're planning a capital raise anytime soon.
Yeah, thanks, Joel. Look, I get it's probably the most common question we get at the moment with respect to our balance sheet, really, is the question. Investors will have noted that at the end of last year, we had about 21 million cash on hand, give or take a little bit around that number. We printed 15 million cash on hand at the end of first quarter. And therefore, there was an extrapolation by some in the market saying, yikes, that's very, very punchy, and therefore we're going to run out of money very shortly. I can tell you that We've recently received, or last week received, $6 million as part of a tranche of an overall $15 million Critical Minerals Accelerator Initiative grant from the federal government. We've already announced that to the market, but we received 6 this quarter. I would expect this quarter to net out somewhere around the same, broadly the same number as where we finished last quarter. So, at 15 million or so, give or take a little. I think we're going to be largely going sideways. And you're going to be saying, well, how have we done that? Partly it is the government money. The other part of that is we are now going into a period of lower cash burn. So the technical consulting and other advice that we're contracting out to those dozens and dozens and dozens of engineers and technical types, they're being scaled back as we get closer to delivery of the feasibility study. And in fact, our second half burn rate is really only a fraction of our first half burn rate. So I think I've just told you where our cash is at the moment. I think I've just told you effectively that the burn rate in the second half will be lower. There is no plans afoot at all for a raise, and I'm looking at the back end of the year before we get excited about those sorts of issues.
Thanks. Well, and on the back of that, Joe, what about bringing on board strategic investors and other partners?
Thank you. So the numbers I just spoke to you about are really the working capital for the FS and the broader business. If we were to find an opportunity set, an acquisition or a need for something specific to bolt onto the business, then we may look for a raise for those purposes. I'm not suggesting there's anything on our radar at the moment. What we would do is tend to bring in specialist money for that. These are dedicated battery, critical minerals and green funds. Partly because they understand the nature of these investments, but also partly we want to look at building a book that has a stronger institutional component and, starting to whittle down some of the retail end of the book, because I believe that we need to improve the quality of the book by a deeper understanding of that relationship. And I think the way to do that is really to look at overseas money in particular and institutional money.
Okay, thanks. It's very clear. We're closing in on the 45-minute mark, but there were a lot of questions. I just thought it'd be fair maybe to wrap up on this one, and it'll be for Andrew. Just in terms of the DFS, do you anticipate any major delays, in particular with thoughts around federal and state permitting, especially in regards to environmental?
Let's just sort of split that a little bit. The DFS itself, as I sort of characterized earlier, is essentially an engineering style study focused on the costs of the project. The permitting and approvals fits more under the EIS. Now, they are linked, but they're not necessarily on the same time frame or the same outcomes. In terms of the EIS, we've been progressing all of our studies. There's on-ground, in-field studies are now largely complete. There's a couple of little ones to follow up in around August, September, where we just missed some seasonality on some previous studies. Again, a little bit more detail. We've sunk a number of groundwater bores, and so we're collecting groundwater data. That's feeding into our groundwater model. So those sorts of things do take a while to collect sufficient data to make it appropriate for an EIS submission, but we're working towards putting that in. The context of once that goes in, then we will be having that assessed under the major project stream within New South Wales because of the size of the project. And that doesn't mean that there'll be a shortcut or a different assessment process. It just means that it'll be elevated to that level of kind of concierge service where the major project stream has a dedicated group of people assessing them as opposed to going out to all the various departments. And so being a major project just gives that a little bit more clarity on the government side about how they're going to assess it and approach it. And so it's very hard for us to be super definitive to the market on how long it'll take. But the guidance that we've received is somewhere between 6 to 12 months on the permitting, subject obviously to the quality of our application going in. So that's probably as much as I can really share at the moment.
Thanks. I know you guys are all working very hard in your team, just trying to get all that stuff done as soon as possible. Look, we've reached the conclusion of this webinar. We hope that it was informative. We've got a lot of questions, particularly around the refinery strategy. If anything remains unclear, please do not hesitate to reach out to myself or any of the team members, and we'll certainly get back to you on any questions you may have. And I apologize to the questions I didn't get to. We'll try and get back to those individually. But really appreciate taking the time to listen to us lay out an update of what's happening on the ground and an update of how we think things will be progressing over the next year or two. So with that, I'll draw the close. Thank you, Helen, Joe, and Andrew for joining us. And thank you all for listening.